Thanks, John. Appreciate that. So from a corporate finance perspective, when we're kind of encounter this kind of client situation, the first thing that we're going to do is to help our client think through valuation as a base case. So just a quick show of hands. Anyone owns a transportation logistics business? Anyone? Okay. Anyone has done M&A in the past? Acquire, sell, just show of hands. John, of course. Yep, okay, that's great. So the first thing that we do here, as the slides indicate, is to get a base case, and the base case here is the valuation of MWT. When it comes to valuation, it's more of an art than a science, and there is not one methodology that's going to give you the answer. So within an M&A context, what we typically do is look at value from multiple points of view. So the first thing that we do is the methodology we call public company comparisons. So for Meyer Transport, we looked at the public companies in the logistics and transportation business. So it's C.H. Robinson, it's Mullen in Alberta. We also looked at XPO Logistics and J.B. Hunt Transport, et cetera. And the challenge that people talk about when you look at public comps is that there's a ton of differences when you look at public companies compared to MWT. It's much larger in scale. It's more diverse. It's in different geographies, et cetera. But it actually gives you a pretty good data point as part of valuation, because it does give you an idea of where the market sentiment is for that sector. Right? Whether as a whole, are they trading at a 52-week high? How is the market thinking about the transport sector, et cetera? And it gives you a really good sense of where the optimism or pessimism of the market. The second thing that actually is very important to look at public company multiples is one of those public companies may be a buyer, and knowing what they're trading at tells you whether acquiring MWT will be accretive or dilutive depending on the multiple. So we will look at public comps. Here in our comp set here is about 6 to 10 times EBITDA. The next thing that we did was we looked at precedent transactions, so deals actually being done in this space. And this is actually intuitively one of the best metrics to look at. So other transportation, other logistics businesses that are being sold in the marketplace, highly, highly relevant. The only challenge with precedent transactions is that most of the statistics are not publicly available. And a lot of times with our own client base, our clients will say, I heard, ABC trucking was sold for 10 times or 5 times, and without being privy to the details of the deal, was it all cash? Was it cash plus stock? How was it structured, et cetera? It could be a little misleading. However, it is a very, very good set of data for us to look at. The other thing that we looked at here with Meyer Western Transport was the level of activities. Even if the multiples weren't disclosed, we looked at how many deals are being done, which will indicate a level of activity. So for this example, roughly ranged from about 5.5 to 9 times. The third thing that we did here is the discounted cash flow analysis. This is probably the most empirical, more thorough analysis to valuation. So we looked at Meyer's forecast, historical and over the next 5 years, and we broke it down to a free cash flow level. And in the M&A business, we talk about multiples of EBITDA all the time, and it's actually EBITDA is not as important as free cash flow, right? In our world, we say EBITDA because we think EBITDA is a proxy to cash flow, but for trucking and transportation business, that may not necessarily be the case because it's fairly heavy in CapEx. So and the other thing that we say is you can't put EBITDA in your pocket, you only can put free cash flow, right? So that's why free cash flow is important. So we for this case, we looked at the forecast, we made a bunch of assumptions here because we lacked the detail. We did a DCF analysis and applied a discount rate that reflects the risks of the business and also reflect the risk of the industry. And we came up a valuation that kind of implied a 4 to 6 times EBITDA. And the last point of reference that we did was what we call a leverage buyout model. And the leverage buyout model essentially is what is the financial value of this business based on our ability to raise capital. So looking at the balance sheet, looking at the free cash flow, how much debt can we put on this business, senior debt, subordinated debt, and then the last piece of the capital box would be the equity. And what is the required return for equity in the current marketplace? So you look at the various stack of capital and what's the required return on those various stacks of capital and back into a valuation. So looking at all 4 valuation methods, we would come up to a range that basically is about 5 to 7 times for this business. Okay, and the chart on the bottom left will also indicate that although the fair market value, looking at the 4 methodologies, is around 5 to 7 times, if you run a competitive process, you could actually get a spike bid. And this is where price may not necessarily equate to value. Price is influenced by competitive process, by strategic rationale of the buyer. And the way we like to look at it is, for every company, if we look at this little bell curve, if we run a process for MWT and we get 10 offers, 6 of them is going to fall between 5 to 7 times. 2 of them is going to be below that, and 2 of them could be above that, and that's what we call the spike bid. So that's the value. The only thing that I would like to add is valuation is very industry and sector specific. So for a trucking and logistics business, we would look very very heavily into their CapEx, because we just made an assumption for our case that is $750,000, which is not a lot. But for all logistics businesses, we would really get into the fleet vintage analysis, repair and maintenance, residual value, sustaining versus growth, because that actually ultimately makes a huge impact on free cash flow, not necessarily EBITDA. So that's the valuation, and why I started with the valuation is because that allows me to get a base case to assess the acquisition opportunity. So for MWT, they had 2 opportunities in front of them, right? One is to do a tuck-in acquisition in Alberta, and the other one is to acquire a property in Prince George and launch a new facility over there. So now that we know it's about 5 to 7 times EBITDA, that's their base case, let's call it 6 times. Now we look at, okay, how do you think about the tuck-in acquisition in Alberta? And before we get into the mathematics, it's important to say that for all acquisition, it's not about the math, it's about whether it aligns with your corporate strategy. Acquisition strategy starts with your corporate strategy, where does the business need to go, and you do a gap analysis to say, does this acquisition fills that gap or it doesn't? Is it organic or is it through acquisition? So that's the first thing that you think about. The second thing that you think about is whether it matches the shareholder's timeline. So parking those 2 things first is to say the mathematics is the tuck-in acquisition is $7 million, which is in the case, and I know you guys haven't read the case yet, but there's an opportunity to pick up a business that is struggling in Alberta. So they basically, for $7 million, they could buy the rolling stock. And the MWT management team thinks that they could get about $2.5 million of cost synergies out of the acquisition. So if you think about paying $7 million for $2.5 million of EBITDA, that's about 2.8 times multiple for that purchase. So mathematically, it actually makes sense because MWT is trading at 6x, and an acquisition will allow them, at 3 times, it's accretion to about 3 turns EBITDA. So that's kind of the simple logic of it. If you actually apply, if you think about a dollar amount, it ranges about anywhere from $5 to $10 million of net present value to the shareholder. So it's a good deal, okay? But the qualitative consideration with in this case would be they've never done an acquisition. So if you've never done an acquisition, there's high execution risk in terms of whether you can do the deal correctly, do it in a timely manner, and actually realize your cost synergies. And I'm not going to read some of these bullet points here, but definitely, in my view, the biggest issue for them is to say, how real are those synergies? How quickly can they integrate? And whether it lines up with their strategy. The second opportunity for them would be to buy the piece of property. And although real estate is safer than rolling stock, according to the case study, it's actually a 6-year payback. So 6-year payback, you look at the shareholder timeline, does that actually make sense? That's something we have to think about. And the other thing that we looked at with the Prince George property acquisition is not only is it 6 years, it's actually a greenfield build. So we don't have enough details, but there's a build-out cost associated with the Prince George opportunity. So how much in further investments we have to make to build out that location, et cetera, it has to be considered. And I would say as an ending comment is mathematics is one thing, but you go back to what John was talking about in terms of the SWOT analysis. So, the way you assess these opportunities is that does this acquisition actually allows MWT to take advantage of the opportunities that we talked about? We talked about going across the east. We talked about going into the U.S. We talked about there's an issue here with this company that are very west focused and end market focused in terms of forestry. We talked about the opportunity around leveraging the technology, and none of these acquisitions actually satisfies those strategic imperatives. So those are the things that we would have to think about for sure. And last but not least is once you know the value of your business and understand what is some of the implications around those different growth opportunities, the next step for us is to sit down with this client to talk about what drives value. Most private company owners do not know what's the value of their business, let alone what drives value. And so what I put up here is a valuation framework, and I'll give you 30 seconds I'll spend 30 seconds to set this up. So me and a really good friend of mine who works at a tier 1 private equity firm in Canada decided to sit down and looked at all our deals that we've done in the past 18 to 24 months and put a framework together. This is not notional, it's not theoretical. We just said, looking at all the deals that we've done and that we've passed, what was driving value in those deals. So on average, we do about 40, 50 deals a year across Canada, and we look at and we pass on many, many more. The partner that we worked with was Fulcrum. They look at 300 to 350 deals a year. They would put in about 15 to 20 expressions of interest. They will get to the next round for about 10 to 15 deals, and they will do 3 deals a year. But from 3 deals a year, it starts from looking at 300 deals and weeding it down to those 3 deals. So Fulcrum and I sat down and we said, okay, we know what drives value in a business. Anything that impacts, if you look at the far right in the chart, anything that impacts the quality of free cash flow or anything that impacts the growth of free cash flow will impact valuation. But we went deeper than that. We said, okay, what are some of the detailed variables that we keep seeing over the past 18 months that really impacts value? So there's actually 33 things that we put down. And we categorize them under kind of 5 major buckets that you see here: market, quality, growth, supply, relationship, governance, HR, and processes. The top 4 are external, and the bottom 3 is internal, okay? I'm not gonna go through everything here because we just don't have the time, but it will be an interesting exercise for you guys to kind of think about or self-evaluate, self-assess where your actually businesses lie. So for MWT as an example, what I think about what drives value for that business is number 1, from an M&A perspective, what drives value is that they have to be a national business. National businesses has way more valuation than a regional or Western company. So going back to acquisition, they should be looking at growing central or even east. So US, Toronto, Manitoba, Saskatchewan, that's what they should do. The second thing that they need to think about is that proprietary system. Currently, there's no value to it because there's no third-party customer to it. So would it make sense for them to spin that technology into a holdco and start attracting third-party customers? The third thing I would say that impacts value, which goes to addressable market, will be that they got way too much exposure into the forestry sector, and they need to diversify their end market. Peter, I'm going to get you to come up here. You can look at all this. Everything will make sense. And most of the business owners will say addressable market is something that we can't control. But I would say you can control it, and actually drives the biggest value in your business. You just gotta pivot your strategy into to redefine your business so that your addressable market is an area that has super high growth, and we can talk a little bit about that.